Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the sugar and cocoa markets for Thursday, May 5th. This is the first in a number of updates we'll be putting out today discussing a rash of failures in a number of the commodity markets, especially in the softs and the energy complex, that we believe could have far-reaching implications for the weeks and even months ahead. Starting off here with a daily linear scale chart of the July cocoa contract, you can see that by virtue of the extent and sharpness of the past couple of days relapse below the 3130 risk parameter we've discussed in recent updates, that failure combined with the market's rejection of the exact 50% retracement of March-April's 37.75 to 29.25 decline, we believe confirms the April 29th high at 33.48 as the end of a three-wave and thus corrective sequence that is consistent with a major peak and reversal threat that we believe exposes sharp, sustained, even perhaps relentless losses straight away to significant levels below that April 1st low at 29.25. A crucial byproduct of this week's setback and rejection of that area is the definition of the 33.48 high as a key resistant high and specific risk parameter this market is now required to recover above to mitigate what we believe is a major peak and reversal threat. We've been discussing, looking at a weekly log scale chart, we've been discussing the prospects of a major reversal lower ever since the extent and impulsiveness of the March decline that defined the 37.75 high from early March as the end of a five-wave Elliott wave sequence dating all the way back to that 25.95 low from September of last year. The extraordinarily high bullish sentiment levels that accompany that major peak contributed to this and continues to contribute to what we believe is a major reversal threat. But not only do we expect weakness below the 29.25 low from early April and even the 25.75 low from last September, but if you move to a monthly log scale chart, it's arguable that that 37.75 high from early March completed a major five-wave Elliott wave sequence that dates all the way back to the July of 2004 12.99 low. This exposes significant losses in the weeks, months, or perhaps even years ahead. These issues considered, traders are advised to move back to a bearish policy, approaching interim recovery attempts as selling opportunities with strength above 33.48 required to negate this call. For shorter-term traders with tighter risk profiles, looking at a 4-hourly chart here, we believe the 32.11, what we suspect is a minor first wave low at 32.11 from early Tuesday. The market should sustain impulsive behavior below that level. Shorter-term traders with tighter risk profiles are advised to establish bearish exposure with strength above at least 32.11 required to warrant them taking defensive action. Looking at the sugar market on the July contract, you can see overnight's accelerated losses within the context of the much broader bear trend shown on the daily active continuation chart log scale here. We think there's the developing prospect, given the acceleration of the past month's decline, that the sell-off down from the 31.05 high from early March is a extended wave sequence that should or would not surprise by further relentless losses in the days and weeks ahead. And on this larger degree scale, we believe the market has defined the April 25th high at 23.96 as the corrective high. This market needs to recover above to confirm a momentum failure of a scale sufficient to buck this broader downtrend. From a shorter-term perspective, shorter-term traders with tighter risk profiles are advised to trail protective buy stops to that 22.43 corrective high from Tuesday. If this extended, really weak Elliott wave sequence down is correct, the market shouldn't even come close to this recent corrective high, let alone recover above that level. From a longer-term weekly log scale chart shown here, you can see the developing dominance of this broader bear trend after a major peak and reversal completion. The five-wave Elliott wave sequence up from last May's low to the February high at 36.08, combined with what has been extraordinarily bullish sentiment levels and sentiment levels that are still high given the extent to which this market has gotten beaten up over the past few months. And on the heels of a confirmed bearish divergence in momentum, all technical factors continue to support a policy calling for for further and possibly accelerated, even relentless losses straight away. These issues considered, a bearish policy and exposure remain advised, with strength above at least 23.43 and preferably 23.96 required to defer or threaten this clear and present bearish count. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trading.